Hello and welcome to another episode of Kuvera Insights, where we speak with industry leaders on what's going on in the markets and how you can use equity to grow your wealth in the long run. Today we have a very special guest. He actually doesn't need an introduction. Mr. Prashant Jain. He is the Executive Director and Chief Investment Officer at HDFC Mutual Fund, one of the largest AMCs in India with 4,38,000 crores of assets under management. Prashant himself has a very rich and storied career in capital markets, having spent 30 years in investment management. He personally manages over 90,000 crores in AUM and also has one of the, I think, rare distinctions of having managed a fund for 26 years. Prashant's background, he has a management MBA from IIM Bangalore, and he is a Bachelor of Engineering from IIT Kanpur. Welcome, Prashant. I hope you're doing well.
Well, thanks, Gaurav. All well, and thank you for hosting me on this program.
Our pleasure, and thanks for coming over. So let's start with, I think the first question that I would personally also love to know is, you've spent such a long time in Indian capital markets, right? What would your view be looking backwards? What were the 2 or 3 pivotal changes that kind of led to whatever growth we have seen in this space, and what lies ahead in the future? I mean, in terms of, if you look at equity participation, we are still, in the low single digits, while other countries have much higher equity participation. So going forward, what else do you see will change or bring momentum to this trend?
Thanks, Gaurav. It's a very pertinent question, and I think the packaging of equity markets has clearly changed a lot, and hard to recognize the two are so different from each other. Those were the days when there was, open try bidding and stuff like that. And now, of course, we have all electronic trading. I think while a lot of technology and packaging has changed, the core remains the same. And markets way back then used to be driven by sentiment, by greed, by hope, by fear. And the same is true now in the near to medium term. And of course, over the long term, as I have experienced number of times, markets tend to do what fundamentals would suggest. And I started my career way back in 91, when it was one of the biggest periods of excesses that Indian capital markets have witnessed. The index went up almost 10 times between 88 to 92. 400 index, Sensex became 4,000. Right. So I think, but eventually all those excesses corrected, and 2000 saw the same with the technology, 2008 saw the same with real estate and power utilities, etc. So I think the places where there are excesses, they keep on changing. But I think the core of the markets remains the same. In this period, the industry, the mutual fund industry, the intermediaries, the broking, the IFAs, the national distributors have all evolved a lot. I still remember when, nothing would sell but mutual funds at par. Only at par funds could sell. And I think we have clearly come a long way. The retail investor, many of them have matured a lot. Longevity of, way back then mutual funds used to be looked upon as shares, and now clearly there is far better understanding. I think what has gone into all this is, of course, a generational shift of people. And India, as you know, every 10 to 20 years, we have a new generation of savers. The current generation is far more secure, well-informed, risk-taking, open to new ideas. And of course, technology has changed, regulations have changed, expense ratios have come down, costs have come down, transparency levels have gone up, distribution has become far, far more well organized. So as you rightly said, while we have come a long way, we still have a long way to go. I think it's a continuous process. And I think the current low interest rate environment the rising confidence, especially of the younger class, I think bodes well for equity participation and for allocation to equities in household balance sheets.
Great. Just to pick on one point, right? I mean, you mentioned that there is this cyclicality of excesses that keep on coming back in the market. You mentioned 88 to 92 was one such time, and then of course, 2000, and then 2006 to 2008. For an investor, right, and most of our users, they are they are they're investing in mutual funds, they're managing their own portfolio, either with the help of an advisor or themselves directly. Are there ways that you have seen in your career that can help someone identify that they are going through a period of excess? And would you characterize what has happened in the last 1 year as one such period, or is it only possible to identify these period of excesses when we look back at them?
I think there are some very simple ways in which you can get a sense. See, equities are both an art and a science, and that is what uh, makes it possible to be roughly right. I don't think one can be precisely right in markets, but broad sense one can definitely get. As simple as look at valuations, look at P multiples. If you are buying a reasonably mature business, even with higher promise of growth at 60, 80, 100 P multiples, it is time to be cautious. And I'm not sure if everyone even understands what 100 P means. I think that is the first thing that you must at least try to appreciate. What does 100 P mean? And you can go back and check in history that whenever businesses have traded at such expensive valuations, what has been the medium to long term outcome? And in most cases, you will find that the medium to long term outcomes have not been good at all.
Right.
I think sharp increase in retail participation, rapid rise in stock prices, expensive valuations, at least in pockets, and a rapid rise in primary market activity. These are signs which suggest an excess, and it does not mean that markets will correct tomorrow. This may continue for some time, it may continue for 1 or 2 years. But eventually, if you keep on moving the way we are moving in this direction, I think it's not a big correction, at least it is time to moderate one's returns expected.
Fair enough. Fair enough. And if you think about some of the fairly simple signals that Prashant has just spoken about, quite a few of them are true today. There is a massive increase in retail participation. Valuations are higher compared to history, and we've had a pretty big run up. So tell us about where we are, and where you think we are in the earnings cycle, and where you think we are in terms of how this earnings story is going to play out. Because like you rightly said, the way that markets are valued today, the only thing that can bring some rationalization is an earnings recovery. So what are your views on there?
Gaurav, I think, see, one, earnings are genuinely recovering. And last year was a year impacted by COVID and lockdown.
Right.
But very counterintuitively, very surprisingly, that was one of the best years for earnings. And the reasons are, of course, varied across the sectors. For example, banks experienced the end of the NPA cycle last year. Businesses like IT, pharmaceuticals, FMCG, they are typically not much impacted by last year's conditions. Commodity prices have gone up very counterintuitively. That has helped the commodity sectors in India. And the consumer discretionary part, the airlines, retail, automobiles, white goods, brown goods, that were meaningfully impacted, are still impacted. They account for maybe 15-20% of the markets. And that's why this massive earnings recovery was possible. I think, however, as I said earlier, in fact, barring 1992, when across the board almost everything was expensive, the markets then were trading at almost 40x, 40 times the broader markets.
Right.
I don't think we have seen such valuations since then. And post that, whatever excesses have been there have been in portions or pockets of the markets. 99 tech, 2007 power, NBFCs, etc. Today, I think the excesses are not as much there in large caps as they are there in some small and mid cap pockets.
Right.
In large caps, there are sectors that are expensive. Like I personally find consumer oriented stocks to be pretty expensive in India. And but I mean, that's not a sector which is going to collapse because it's a very steady, secular growing sector. And last time when we were in a similar situation was in 1995. And for 10 years, the stock prices, or 5-10 years, the stock prices remained flat.
Right.
So the earnings grew, prices remained flat, P multiples gradually moderated, but the stocks per se did not come down, correct sharply.
It was a time-based correction rather than a
It was a
price-based.
time based because that's the nature of the business. The business is extremely less volatile. I think the this time around we are seeing some excesses in the uh, small mid cap space, and I personally find the chemical space to be pretty expensive. While it's a growing sector, it should grow. We should grow our exports. We should gain share from China. But I still feel, given the characteristics of this business, the high multiples appear excessive to me. What is happening in the new economy space, while definitely the share of profits, the share of economic activity by these new age businesses will go up. But I am sure there will be many failures as well, many disappointments. And the valuations, what we are seeing, make me somewhat cautious. And we are also seeing a very large supply of stock in the primary markets. And you will see a clear trend, whichever pockets are most expensive, that is where most of the supply is seen. Because that is where the entrepreneurs, the PE investors, they would like to reduce their risk. Currently, if you see, a lot of supply also is in these two areas. So I don't think these are two areas which account for more than maybe 15-20% of the aggregate markets.
Right.
If you think 3-5 years, I think these markets should still deliver returns that are more than bonds comfortably. But still, I would say it is time to be cautious. It is time to focus on sustainability, valuations, and remain diversified.
Very, very fair point, Prashant. You briefly mentioned on new age economy, IPOs. Can we talk a bit more about that, right? I mean, there is the good news is that, or one way to look at it is that, the startup economy is maturing and some of these companies are doing an IPO. However, the point you made is that, some of those valuations may look really rich unless these companies are able to show that phenomenal amount of growth as a public company, which of course carries a lot more scrutiny. Also, how do you look at these IPOs, right? I mean, do you look at how much of the money is being raised at capex, or how much of money is just promoters selling shares? What are some of the easy ways for an end investor? Because we are seeing a lot of these IPOs being massively oversubscribed by retail, right? I mean, these are household brands, so there is a familiarity here. What would you kind of, advise these IPO investors? What are some of the key things you would want to look
One, Gaurav, whenever you are faced with the prospects of easy money, you should be cautious.
at? Okay.
That is one very simple rule,
Right.
and it seldom fails you. And the whatever the majority does also doesn't prove to be right in stock markets at least.
Sure.
It is true for elections, but not true for capital markets. Because whatever everyone wants to buy, becomes very expensive, and what no one wants to buy becomes very cheap. So I think more often than not, uh, if you do what the majority is not doing, or the opposite of that, the risk reward is more favorable. Now, coming to these businesses, I think these businesses are wonderful for the country. They are wonderful for the economy because, in aggregate, they will create jobs, they will create very competitive new age businesses. Some of them will become global businesses. They will get a lot of capital into the country. So I think it is absolutely wonderful, essential, very promising for the country. But what we are discussing here is uh, the our assessment of these businesses as investors in capital markets.
Precisely.
Here, I think the answer is not very clear because the range of outcomes of these businesses is extremely wide. Very, very. If you think 5, 10 years, I mean, some business can go from 1 to 100, some may go from 1 to 20, or some may not go anywhere at all. I think there is very little past history to go by. These are business models that are not mature. These are business models which may get disrupted over time. So I think range of outcomes is extremely wide, and that is what makes assessment of these businesses extremely challenging. And the way I would approach it is, first I would see, does the business have a sustainable competitive advantage? If it has a sustainable competitive advantage, at least survival is reasonably sure, and it will grow. How much it will grow, time will tell, and it should be profitable over time. And then I would look at the possible range of outcomes, and if the risk reward is favorable, or if there is some margin of safety, then I think it's a worthwhile investment. Otherwise, it is not. And in any case, I think given the very wide range of outcomes that these businesses are likely to experience, I think it would make sense to remain effectively diversified across several such. But I don't think there are any easy answers.
No, that's really fair, and I think some of what is happening is at least a lot of companies in the US in the past 20 years in the technology domain have been able to grow internationally, and people are just trying to say that okay, the same thing can happen in India. But yeah, like you rightly said, it remains to be seen. It's not a simple slam dunk that hey, you know what, they're growing profitably and the market is really huge. So coming back to personal finance, coming back to kind of the retail investor, what is that one piece of advice, right? In the 30 years that you have seen multiple cycles, you have seen probably uh, enough investors and enough investment biases. What is that one advice that you would want to give to our users and our viewers on how they should manage their portfolios?
See, I think equities appear to be deceptively simple, but they are not easy at all. And so I think people who have not experienced equities for a while, they should be cautious. They should follow certain basic principles. Uh, they should commit only the risk capital to equities. Risk capital is that portion of your wealth which you don't need for 3, 5 years, on which you can tolerate volatility emotionally and financially. Don't commit more than that. Never borrow and invest in equities. Uh, invest, I mean, I have seen a very strong correlation between valuations at the time of investment and the eventual outcome or the returns. If you overpay for a growing business, it is less likely to turn out to be a good investment. If you bought technology 99, technology companies in India, the software services companies in India have never had one negative year. They've grown for last 30 years. But if you bought at wrong P's for many, many, many years, you made no money.
Yep.
On the other hand, if you buy even a slower growing business cheap enough, it may turn out to be a better investment. So I am not in that camp, though time will tell whether that view is right or wrong. I'm not in that camp that says that for a quality business, any price is good. It does not matter. I have seen a very strong correlation between entry valuations and returns. So we should pay heed to not just growth, but how much of that growth is already built into that. And finally, I think the future is uncertain, and neither me nor anyone else is in a position to forecast the future. So I think it makes sense to remain diversified across businesses, because I'm sure, especially in these new age businesses, many will disappoint and some will have absolutely wonderful success. But the key is, uh, not to those. You should not be overexposed to businesses that don't do well. So I think reasonably well diversified portfolios, especially in new age businesses, I think is advisable.
Great, great. That's very helpful. Just one last question, right? I mean, um, do you, and this is more of a hypothetical question, right? Uh, how does a retail investor, right, who has a day job, who's working a day job, and is probably also investing, and some of the things you talked about, you have to understand the underlying mechanics of an industry, what kind of drives profitability, what drives growth. So how does a retail investor become good at these things? Is it just a matter of time and kind of keep on applying yourself, and then hopefully one day you have enough? Or because it's also like you also kind of alluded to earlier on, investment management is a very competitive field. There are a lot of investors each trying to kind of find out the next stock or the next company that's going to give them great returns. So how does a retail investor fit in this whole picture?
Gaurav, I don't think there are any easy answers. And even after spending 11, 12 hours a day for 30 years, 5, 6 days a week, I still make a lot of mistakes. So, uh, so I don't think the answer is simply in the number of hours. And I think largely this business is commonsensical.
Okay.
And EQ also plays a very important role, more important than IQ. I don't think this business needs lots of IQ. What it does need is lots of common sense, lots of emotional stability, and to my mind, focus on value. And these are part of your aptitude. And I don't feel that spending hours on spreadsheets are going to give you the right aptitude. Of course, you can listen to others, you can read the experience of others, and you can develop that aptitude or whatever you think is right for you. I think, but please appreciate a capital market is one place where behind every trade there is a buyer and there is a seller. And for the same company, same time, same price, same everything, same EPS, same PE, same estimates. The two people think differently. And unless the two think differently, the trade will not take place.
There is no market without a difference of opinion.
There is no market. So I think we have to live with that, and may the person with the right aptitude, right thought process. In, but in all humility, I would also say that in my 3 decades in these markets, the majority has seldom been right. Whatever the majority has done, whatever, it has proved to be not a great investment. And I can give you a list of 10 such instances. So I think the investors should be doubly sure, doubly cautious when they are on the side of the majority.
Perfect. That's very well said, Prashant. And I think one of the key things that will stay with me is that equity markets look deceptively simple. I think that's probably a very profound statement, and it's a very deep statement. Thanks so much, Prashant, for your time. Really lovely chatting with you today.
Pleasure, Gaurav. Thank you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.